Again here. So we'll start where I left you. Consolidation. Stay tuned. Next part is financial. So financial is everything. They will tell you how much loan they have taken, what is the net worth of the company, how how they're performing, and what is going to be future. So most important thing here is debit. Debt means how much loan they have. By seeing here, you can say they have zero loan. So you always prefer zero loan company. So it's best you always prefer zero loan company. Why? Because if you are taking zero loan company, they don't have to pay any any of the tech, uh, any of the interest. But most of the company, see, net worth is 63,500 crores, and they can have 100 or 200 crores. That is fine because they're just putting loan just to save the taxes. That's all. So 100 it will be like point 0.1 point 0 something something. So if it is 600 crore, it will be 0.6%. So basically that is fine. They have just put, that is they have just put for saving the loans. Sorry, they have just put to save the taxes. Now second part is net sale. So these are the cells you can see. So you can see the cells are increasing rapidly. September, December, March, June. And this is the other important part, other income. So other income, their specialization is in IT. They are doing other business too, like warehouse, or they are giving some loan or something. Other is PBDIT. It's a profit before tax. So these are the profit before tax, and it is net profit. So net profit, you can see it's keep on increasing. So it's good company. So always prefer where the net sale is keep on growing and net profit is keep on growing. That is the good. Now you can also go to the financial section and see all in the big picture. So just click it here. Wait, it will load. Once it will load, you'll see like this. This is basically balance sheet. Balance sheet is basically every year how much they have loan, how much they have asset made, everything will be balanced. Balance sheet means the name itself decides it's a balance. So you can see here assets and here liabilities. So you can see total capital and liability is this much. Liabilities basically loans or anything they have given, tax or something like that. Asset is same. See here both are same. So every year this will be same. So you don't need to worry about this. So you have to see profit or loss here and just go. So it will load. So you can see it here how the total revenue is keep on growing. So it's good stock. It is always preferable if the stock is growing each and every year. And you have most important part is you have to see the net profit. So net profit is here 10,000, 12,000, 12,000, 13,000, 16,000. So it's keep on growing. So you can target this stock as per the profit and sales. So you can see this is PBDT something. So one important factor will be depreciation. So every year they'll use some building, so they will depreciate. So they have to pay. It's like they're using some machine, and machine slowly it is getting depreciated. Its value is degrading. Like you are buying a car, and after 1 year, its value will be go down by 10%. After 5 year, it will value will go down by 6%, 60%. So slowly it will depreciate. So expenses will cover all those, and profit loss before tax. So they have not paid tax, still they are maintaining these many profits. Thanks. Stay tuned for better improvement in stock.